that silver is about to launch a handful of month, couple quarter surge out of this now 50-year range into a new price reality. And I think at minimum that will be 100 plus. More likely it's going to be 200. And I think much of that will occur in the next 6 months. And there is one primary signal metric that we're watching for that, and it's not price, it's not momentum of price. Silver's already in a bull market. There's no issue about it. The issue is, when does it go ape on the upside? But you're in a new price reality. You're going to live in a new range between 150 and 250, maybe. I don't know, maybe even higher. Depends on the degradation of the money unit that will likely happen if the stock market breaks down and sparks the central banks again into doing what they love to do, destroy the money unit. Anyway, but this chart screams at you. You know, I've got open field running above me, and I've set that structure pristinely. Yes. Yeah, that chart should be nailed to a wall. That last 10 years worth should be put up on a wall. That is a beautiful chart.
You're watching CapitalCosm. My name is Danny. It is October 17th, 2025, and my guest today is Michael Oliver, who couldn't come at a better time, actually. I don't know how we timed this so well, Michael, but it seems like we can lay to rest the gold and silver market. No, I mean, things have pretty much gone off a cliff.
Yeah, they're all over. We don't need to talk. Okay.
Pack it up and just go invest in NVIDIA, I guess.
If you go back and look at the explosive move in 79 to 80 or 2010 to 11 in silver, the number of times you went through what we just saw today, probably a dozen or 20 times. You know, we had a 6% sell-off in silver early in the week between the 13th and the 14th, Monday and Tuesday. Okay. Is that right? Yeah, Monday, Tuesday. A 6% sell-off. Okay, then we made a new high today, had a 6% sell-off. And, you know, it's option expiration day, I understand. That explains it. Because almost every time you get to option expiration a day, something happens that, you know, try to get it down. Okay, whatever. It doesn't work because we used to be $30 silver, now we're 50, okay, in a matter of months. In fact, up on the week right now, the settlement price on D silver is going to be 6% higher than last week. So yeah, 2 6% sell-offs this week, redundant mostly, you know, the same turf. And yet we're 6% up on the week, and yet nobody cheers about that. They all bemoan the intra week. I'm just telling you, over the next months, you're going to get more and more of those. But every time you see one that looks really scary and your friends say, oh, it's the top, buy. You do far better buying the 5 and 6% breaks than you do buying upside breakouts, frankly.
Yeah. Well, let's go ahead and do that. Let's take a long-term view of gold here. You sent me these charts before we got on air. So walk us through what we're seeing here. This is a chart, a gold monthly ratio scale since 1975. Yeah, what is this, a price chart or what? What are we looking at?
Monthly closes only. It doesn't show the intra-month highs. Okay. But it's ratio, meaning, you know, if you go to 10 to 100, that's a tenfold. You go from 100 to 1,000, that's a tenfold. They're the same dimension. Okay. Mm-hmm. So it's a log scale ratio scale chart. Mm-hmm. You had that bear low in 1976. A year and a half after gold was legalized, it peaked at 200 and it collapsed into 1976 down to 103. And over the next 3.5 years, it went from 103 to 850. That's an 8-fold move. Much of that occurred in the last 6 months of the move, by the way. But anyway, and then gold plateaued for a couple of decades. It just sort of went sideways, you know, up, down, teasing, but holding ground well above the 1976 low. And then it engaged again, this time from a low in 2001 that was a price of about $260. So 2.5 times the price low of 1976. But and you went from the $260 low in 2001. 10 years later, you're 1960. Oh, another 8-fold move. Same dimension as the first move, different time span, same dimension. And then what'd you do? Oh, again, you had to go into a multi-year, decade-wide range, a new reality of gold rather than the reality that prevailed from that 1983 to 2000 something. And now you're engaged in another upside. Now everybody's screaming when they look at arithmetic charts of what's happened over the last year, let's say. And they say, oh, it's overdone. It's got to, it's, we got to correct, or that's the top, whatever. We're only halfway into the dimension of both of those prior moves. We're fourfold from the last bear market low, which was $1,043 in December of 2015. We're 4,200, so we're a little more than 4 times. You go to 8,500, and then you can at least say, oh, gold's done the same thing it's done twice before since legalized that it did before. And this time under potential conditions that are far more dramatic globally and fundamentally than anything that helped spark those moves. Most specifically, the degradation of the money units by central banks when they panic about certain asset categories that they care about, banks, stock markets, so forth, and data points. They come in and they flood the world with more money, meaning to degrade the real value of the underlying currency, which is an ongoing process anyway. But anyway, so we're only halfway into the dimension of those 2 prior bull markets, and everybody says it's overdone. No, I don't think so. Okay, now look at the reality below, which is sort of awesome because it's not what you see on gold. Now, silver moves month by month, quarter by quarter with gold. Make no mistake, okay? It's the other money unit that's been around for 3,000 years as real money, okay? It made a huge move in the 76 low, just like gold, up to the 1980 high, just like gold. But silver went up from, like $6 to 50, okay? But then it also went into what? Another boring range-bound situation down around the $10, $11 range again. And it had another bull move from that same low, in 2001, when gold turned up as well, silver turned up. Silver went from that level up to 50 again. And again, it got hit. Now, this doesn't show intra-month highs, but actually the high that's on the left in 79 got up to over 50. That high close there is in the 30s. But when you see the intra-month, they were exactly the same as the 2011 high. Right. Okay, and then you do what? You go boring again for another decade, just like gold has done since its 2011 high through about 2020 with sideways action. Silver has only this past week nipped out the high of that 50-year range. We're talking solely price here, an idiot chart. Okay. I call it idiot because if you go back and you factor in the degradation of the real buying power of the US dollar in 1980 to the present, or from even 2011 to the present, if silver were matching that degradation, it'd be $200 plus right now. Okay. Something looking like the gold chart, which is compensated for those ongoing degradations in the money unit. But silver hasn't done that. In fact, I can show you a copper chart. If you go back to the 1970s and 80s, it had a range in price that prevailed between 1970, 80, 90, and into 2000, like 2005, where it was stuck in a horizontal range. And in 2005, I think it broke out of that range and quintupled in a half. No, excuse me, that's erroneous. It quadrupled in a matter of 6 to 9 months. It took out a multi-decade range and quadrupled almost in price, and then lived since then, since 2006-07, in another major sideways range, but a new price reality compared to the prior range. Silver's still just only now emerging from a prior 50-year price reality. So in a sense, silver is much lagged to many other assets. I could show you a lead chart. Our argument right now is not because silver has nipped out its highs, but because of momentum factors and spread relationship factors to gold, that silver is about to launch a handful of month, couple quarter surge out of this now 50-year range into a new price reality. And I think at minimum, that will be 100 plus. More likely, it's going to be 200. And I think much of that will occur in the next 6 months. And there is one primary signal metric that we're watching for that, and it's not price, it's not momentum of price. Silver's already in a bull market. There's no issue about it. The issue is, when does it go ape on the upside? And when we went back and examined the final months of the surge that you see there in 79 to 80, where you went from like $10 to 50 in the final 5-6 months, boom, most of that was like 5 or 6 months in a couple of year bull trend. And you go back to 2010, where you see that jolt right there. Yeah, right there, where you see the jolt upward. From there to that high, it was about $20-something to 50. So it about tripled in about 5 to 6 months. It had been going up for years already, so it was no issue. Silver was already a bull, but what caused it to suddenly go ape, to go vertical, and do it all in a handful of months? The spread relationship to gold was the signal indicator, not the dynamics of silver or its momentum trend, but the momentum and the dynamics of the spread between silver and gold. Right now, that spread is postured early this month to the present below structural levels. Well, you can see that pretty good there.
Yeah, that's the silver to gold ratio, by the way.
Yeah, we're going back to 2020 in particular. You had a big surge there. And that was in that surge when silver, in the first half of 2020 into 2021, you're going back to 2011. Yeah, so that surge right there, that's the one we're looking at. We came up out of the hole there, and in 2020 to early 2021, silver vastly outperformed gold. But then over the past few years, even though silver has been rising during that time, and so has gold, the spread has deteriorated. Okay. We've recently, since April, that spread has shot back up again strongly. You get much above the recent highs, and you're going to break out on various metrics of that spread, which say you're coming out of here. Now, your trend line we don't plot. We have different trend lines. But anyway, what I'm arguing is that this surge that we've just seen in silver is now pressing at levels on the momentum of the spread and the spread itself that say you go any further and you're going into launch mode again. Same sort of behavior occurred at those prior pivot points where silver went from up to dramatically up. And when you looked at those original charts I showed you, realize that silver has not done it for 50 years. Many other commodities have had prior ranges that prevailed for decades and blown out of them, but silver hasn't. Anyway, I think silver's about to do a catch-up, and we know, if you've been around in markets long enough, that markets make mistakes. When you get bubble tops in the stock market and they collapse, later on the prior bulls have been buried, look back and say, gee, I guess it was excessive. I should have gotten out. And when it goes down, it usually overcompensates for its prior upside excess. The same is true with markets that have been depressed for too long. They remain depressed. People dismiss them. They say, there's nothing going on there. Just forget about it. They ignore it. And yet certain realities have occurred in fundamentals and so forth, and in the underlying degradation of the money unit, for example, which is something you have to compensate for. All those factors build up, and finally the market says, oops, I made a mistake. And it comes roaring out of the hole, sort of the opposite of a bubble top breaking. It compensates for the error. I think silver is on the verge of compensating for the error, and I do not think it's going to trend up to a new price reality over the span of 2 years. I think it's largely going to get there in a couple of quarters and then live in the new price reality. And I think that reality is going to be somewhere, wouldn't surprise me, 200 even. And if you go back and factor in, again, the degradation in the US dollar's real buying power, that's be fully justified. Okay. So.
Yeah. So to kind of illustrate your points here, Michael, we've got the silver to gold ratio at the top and the price of silver here down at the bottom in blue. Yeah. And you'll notice anytime this yellow line spikes up, which is silver outperforming gold,
you got it.
Coincides perfectly with
the price surge.
The price surge in silver at the bottom.
I think we're on the cusp of that, and it should be very dramatic. It should not be the kind of investment opportunity that people get to think about over the span of months. If you're not in, you miss it. and all of a sudden you find yourself in a new reality. This has happened in many markets. I could bore you with countless charts of base commodities and so forth, going back decades, showing how a given asset stays depressed for so long, it's ignored, and all of a sudden when it says, oops, I made a mistake, it's gone. New reality occurs within quarters. And I think we're on the cusp of that.
Yeah, let's go ahead and take a look at the silver chart right now. We are down 5% today, a whopping 5%. Silver's back down in levels not seen in what, over 2 days now?
Yeah, really, it's up 6% on the week, though.
Yeah.
I'm sorry,
Yeah, so it's back down to at the very bottom of where we were in Wednesday.
So. Oh, terrible. Anyway, we watch silver futures. This is a spot, I think. But anyway, it's option expiration day, so no doubt some banks or institutions help maneuver a drop in the market. That's fine. Most of the longs are even thinking about taking profits. And the other thing I can stress again is gold is 4 times where it was at the bear low. Its prior bull markets of the last 50 years to them are 8-fold. Okay. You haven't even seen it yet. Imagine if silver catches up, which we think it will, but in a thunderbolt. So not only does gold have the potential just to replicate the 2 prior bulls, which I think it will vastly outpace, by the way, ultimately, silver will catch up, and that'll be an enormous move. Even if silver, if you go back 50 years and look at silver versus gold spread and ask yourself, what's the highest reading that silver had versus gold as a percent scale? And right now we're at 1.2% of the price of gold. In the last 50 years, it's 20 of those 50 years, it's been at 2% or higher. If we even just went to 2% or higher, that's almost a doubling of the current valuation of silver to get back to what's a norm over the last 50 years. If you then go back and look at bull market years in silver versus gold, silver and gold, 79 to 80, for example, 2010-11, that spread was up to 3.5% or even 6.5% back in 1980, but well over 3%. Now, if we went to 3%, that would be a tripling in the current value of silver to gold. You do the math. If gold went to 8,500, which is to say nothing but replicating what it's done twice before, and silver went to 2% of that, silver would be $160. Mm-hmm. If silver went to 3% of that, you get the point. Okay. Silver has a major catch up to do, not only in relative performance to gold, which it's going to do, but in net price. And I think it will be a very compressed situation.
And you made mention of the fact that we were looking at the spot price versus the futures price.
We use December silver. That's all. And it's
gotcha. So here's what I've got charted up here. I've got the spot price divided by the futures price, and you can see spot is what 6% higher, just about than.
Yeah, we've had that exhibit lately. That's occurred, and I think those things are usually temporary, and even if it abates, so that the spot comes back, toward the futures price, and people say, "Oh, well, we had a fire going there where we had no supply of silver bullion in London, so we had to fly it over, et cetera, et cetera." But cooling off that little fire doesn't change the fundamental. The fundamentals are, we don't analyze that, but we know about it.
Gotcha.
For 5 years in a row, we've had demand exceeding supply. New production every year.
I just wanted to showcase that if you look at through history, whenever this ratio spikes up, meaning the spot price overtakes the futures price, right? You go back to the 70s, and it pretty much you had this huge spike up in 74. This coincided with a pretty big silver surge from $1.30 all the way up to $5 silver. Yet another spike up here that coincided with the move from $5 to 50, and then from 04, 03, all the way out until 2011, you had multiple
spikes. Yeah. Now we're coming up from a very low reading in the spikes over the last couple of years. You see very low compared to the others. And only now are we getting back to the sort of what you'd call normal spikes. Okay, imagine you go even higher. But anyway, that can abate very quickly, because that differential can change simply by moving silver from point A to point B, and therefore cooling off the pressure that's on the LBMA right now and so forth. And that doesn't alter the trend reality that I'm talking about, which is far bigger and not so spotty as this is. But that's just an indication that we do have tightness.
Right. So I want to take a look at another correlation here. This is silver and oil. If we can pull it up here. So we've got silver. Okay, we've got silver in yellow, oil in blue. And you'll notice they pretty much track each other fairly reliably. However, recently, over the last several months,
oil is
splitting.
Oil tracks very well, not gold and silver, but tracks the Bloomberg Commodity Index. And there's times when, well, for example, you could take from 2015 bear low in gold to 2020, when it went from 1,050 up over 2,000. Remember that move, okay? We peaked in 2020 and went sideways for a couple of years, okay? Went from 1,050 to 2,000. Same time, the Bloomberg Commodity Index continued down for those 5 years. And oil was under pressure for those 5 years. And oil is now one of the weaker components in the Bloomberg Commodity Index. For example, right now, spot oil is like $58, or spot futures, November contract. And we've got a major upside momentum breakout. Momentum, I'm talking, not price. That if you get back over $68 this quarter, watch out, you're going to go. But we're 58, so it's got to earn it. Meanwhile, the Bloomberg Commodity Index is right now 105.5. You get much over 106.5 on a monthly close, and it's going to move up.
Is this
that's what you got, Bloomberg. Yeah, you can see those are monthlies. I can tell. You keep pushing up to the same level over and over. You get up to 108 plus and so forth. But a monthly close above 106.52 during this year will break out over annual momentum. It's similar to the price chart, but you'll break out over the ceiling. And you keep probing up there like you want to do it. But so far it hasn't done it. And one of the drags on the Bloomberg lately has been recent weakness in oil, which I don't think will continue, but it has been weak. But surely you could look at gold over the last months or beginning of this year and then look at oil. They're not in sync at all. Oil's been weakening, gold going vertical, same with silver. In fact, silver is up more year to date than gold is. Most people don't know that. Yeah, they think silver's the dog, but it's asserted itself pretty strongly, especially since April, May. It turned
60%, right? 65, 66%.
I think it's up more to gold. I know that on a percent now. It's still got a lot of catching up to do to get back to normal levels, like 2% of the price of an ounce of gold. But it has been strengthening sharply this year.
Understood. So what is the price of oil telling us? Is that signaling economic weakness, a recession ahead?
No, the correlation between oil, for example, and economic weakness is not really good. We've had times where you're in recession and so forth, and the Bloomberg goes up and oil goes up with it. So the attempt to connect copper, for example, that is called Dr. Copper, I think, it's like the symbol of the economy, is not valid, technically speaking. Overlay it on recession charts or something like that. Copper, platinum, oil, all those commodities tend to move as a fairly good group within the Bloomberg. They tend to move together as a cluster. And they don't correlate well to global recession. And go back to the late 70s to 80s when gold exploded, Bloomberg finally in 1977 joined the gold trend, which is already headed up, and soared. Not as much as gold, but strongly. It was a global recession. Okay. And the other factor of commodities, and oil too, look at its price. Like Bloomberg Commodity Index in 2008 was at 237. Right now it's 105, and you're calling commodities expensive. It's a cheap asset category. So is oil relative to prior highs, 130, 140. It's less than half those prices. So an economic downturn, it's already reflected one. It can go up if it wants. based on other factors. Anyway, so yeah, that's something I'd be watching, though. I'd be watching Bloomberg and even oil, because yeah, oil looks like a dog right now. But you get up to 68, and on a price chart, that doesn't mean much. But on long-term momentum, you get up to 68 and close a month there or higher, any month this quarter, and that's a green light. You're going up. And probably with a slingshot effect, pretty strong surge. Platinum is a good example recently. People like to correlate it to gold, and it doesn't correlate at all to gold very well. There's a few times in history where it does, but most of the time it is linked to the Bloomberg, meaning it behaves like, in general, a commodity.
Mm-hmm.
But it has shifted into positive trend a few months ago by our metrics. We got bullish hundreds of dollars below where it is now. So it's ahead of the Bloomberg right now, but it still moves like that pack of commodities. But platinum has come out of a totally inverse relationship to gold over recent years. While gold's been rising, it's been in a cheap base of action. No rise at all. No correlation. And I would not, go ahead.
No, go ahead and finish your thought. I'm going to segue into something else here in a bit, but go ahead.
No, anyway, that's my observations here, that these other commodities will sometimes link to gold, but it's fairly rare. But it's quite often in those dynamic bull trends of gold later in the trend where then the Bloomberg will join it in the commodity category. And it's also at those times the stock market's weak. But anyway, and I would not worry about the issue of economic weakness in terms of commodities that are very cheap, like oil.
Gotcha.
If it were $140, $50, I'd be worried about it. But, it's had two highs up there, 140, 130, and we're at 58. Okay. Mm-hmm. It's already discounted anything weak. Don't try to price that in. It's got other factors to think about, like its general price level relative to the decay of the money in it.
All right, quick break here, because if you're buying gold or silver the normal way, you're probably overpaying by a lot. And that's because most retail dealers quietly tack on these huge markups, sometimes 10%, sometimes 20%, sometimes even 30%. And you don't even notice it. It's like paying $115 for a $100 bill. Doesn't make sense, right? So that's why I've been using the Bullion Standard Pro. It's a membership that basically lets you buy precious metals at real wholesale prices. The same prices that dealers get. So no inflated premiums, no middleman games. Their platform updates every 5 seconds, straight from mints and distributors. So what you see is literally the real market. And here's the crazy part. If you buy something like this gold American Eagle, here's the amount of money you're going to be saving at the time of this recording, at least. So it basically pays for itself multiple folds on many occasions, depending on what you buy. And if you want to try it out, they're hooking up my viewers with an exclusive 10% off their first month. Just use promo code COSM10 at checkout. That's COSM 10 at checkout. So if you're stacking, investing, or just tired of getting hit with hidden markups, check them out now. Bullion Standard Pro. Just click on the link down below in the description box and use promo code COSM10. Now let's get back to the video. And the thing with oil is, I believe it did reach negative territory during COVID, but at the height of the shutdowns, initially, I think it, settled at around $30 to $40, if memory serves me correct. I'll pull it up here in a second. And so you're talking about somewhere in the $40 range. We're not too far away from that.
Yeah, but that was an off the page, totally irrational panic.
Yeah.
Because it V'd out of there like hell. It said, hey, what did I just do? This is silly, and this is amazing. It makes the point I'm trying to make about silver too. Mm-hmm. Markets make mistakes. Sometimes they're brief, like that oil collapse there. Like, what are you going to do? Go free? Going to become free oil? Okay, give me a break.
My question is that we shut down the entire world economy and we could only bring down oil to $40. Granted, it went down a little before that, but it settled around $40. So if we're like pontificating of a recession bringing down oil, if a worldwide shutdown couldn't bring down oil south of $40, what can a recession feasibly do in comparison?
Yeah, well, Again, it's been beat up since the war started over there. I'm kind of hoping that we get, quote, world peace, okay? Because I know a lot of people think gold goes up because of uncertainty in the world. That's baloney. It goes up because of the ongoing degradation in the money unit. It inhales and it exhales, but basically it's constantly discounting the destruction that governments inflict on their money unit, okay, over the decade by decade destruction, inflating, etc. Okay, that said, commodities are cheap relative to that asset category. Stock market is appreciated because of that degradation in the money unit, because all that cheap money, free money, went into the stock market for 15, 16 years. They ignored a cheap asset category. Here we look at crude oil at 57. Go back to your left. You go back 3-4 years. And when that war started, crude peaked literally weeks after the late February 2022 high. So when the war started, which was a surprise to many analysts, foreign policy analysts, so it wasn't like it was being discounted, but you soared from 2020 lows, same with the Bloomberg Commodity Index, from that 30 level to 130 without a war. When the war started, you went down, okay? Imagine what happens if you have world peace and all the people who think that, oh, it's uncertainty that causes things to go up. That's what caused oil. No, oil didn't go up because of uncertainty. When the war started, oil went down, okay? In fact, even when the war started, gold dropped from $2,000 to $1,600 between March of 2022 to October of 2022. Anyway, it'd be neat to have world peace. We now have the Mideast solved, maybe, okay, right? And let's say Ukraine thing gets settled in some way that pacifies it. We don't have any war events, and yet commodities turn up. People say, what the heck's going on? I thought it was global uncertainty or gold. You know, that is not a factor. It's relative cheapness of an asset compared to the ongoing decay in the real value of the money unit. For the last 15 years, the stock market got all the benefit of that, but it went to a point of excess. If suddenly the stock market says, oops, like it did a dot-com high, and says, oops, I made a mistake, I'm going to compensate for it. That renewed money flow, which the Fed always does in bear markets in the stock market, they come in to print more money and cut rates. It never works. It goes somewhere else. Cheap commodity asset category is one prime candidate. And oil at $57 compared to recent years is a cheap asset category.
Yeah. Yes. So you mentioned the relative outperformance of the S&P relative to commodities. Here we've got gold relative to the S&P, I should say. And I've got to give my good friend Andy from Finding Value. I saw this on his channel the other day, and this chart goes all the way back to the 1900s, right? So you've got gold divided by the S&P, and then when you kind of draw this three hump consolidation on gold relative to the S&P. And
what are you going to do now? Is you going to go down? It's proven itself for years that I'm not going to go down. In fact, if you analyze that action going back to about 2015 that you see on the bottom right there, you can see a distinct basing pattern. Blow that up if you would. Blow it up as big. There you go. There you go. Okay, you like a base? Don't go back. We had a pullback from it already. I love that. A few months ago in April, you hit there. They banged it back down. I love it because that means it's valid. It's a valid structure. You're now where? Back up to the structure. You go any further, you're going to blow this spread out. And you have nothing but a vacuum above you. You could go back and look at some of the other bottoms, and they're quite similar. I mean, you stay there for years, which is to say par with the S&P during those years. Meaning, if you go back to 2015, for example, where you were at that first low, or any of those lows, multiple years there, it's laying at those lows, but it's actually matching, because it's laying there, going sideways, it's matching the performance of the S&P. So even over the last 10 years, while that spread is laid low, and we're above the lows of 2015 on that spread, by the way, gold has outperformed the S&P during that time. So if you go back to the first low in, let's say, 2015, on that, blow up the chart again, that area, you see those other lows you've made, like there was one there in 2018. There's one in 2022, these lows. If you go back and circle where S&P price was then, and circle where S&P was at that point, and where gold was, gold is beating the pants off the S&P in those subsequent years.
Hard to believe. Gold is up what, 50+%
over that level.
Yeah.
Now, once it breaks out of that base, it's an open field running. It's literally a vacuum.
Good. And then once it breaks out of this pattern too, I mean, could it retrace back up to the?
I don't know. That's once you blow out of these things, don't try to guess. The one thing I would argue is this: those people who are thinking about, oh, when the top comes, that's it. You have a bear market. You might, but we're going to be in a new price reality at that point. And silver, for example, if I'm correct on it, and I think I am, if you come up out of this, not just the price base, which any idiot could see, but you blow that spread out and you go up to 2%, 3% of the price of gold again, you're going to be at $200 silver. And my bet is, oh, sure, yeah, at some point up there, you're going to get a $50 sell-off or more, something you want to avoid if you're trading. But you're in a new price reality. You're going to live in a new range between 150 and 250, maybe. I don't know, maybe even higher. Depends on the degradation of the money unit that will likely happen if the stock market breaks down and sparks the central banks again into doing what they love to do, destroy the money unit. Anyway, but this chart screams at you. You know, I've got open field running above me, and I've set that structure pristinely. Yes. Yeah, that chart should be nailed to a wall. That last 10 years worth should be put up on a wall. That is a beautiful chart.
It is. It is. Before we sign off here, Michael, I want to get your thoughts on the mining stocks. This is the HUI index. If you have another index that you prefer to look at, we can look at that.
No, but that's fine. XAU or GDI. We don't watch HUI, but that's fine. It's finally joined GDX, which is blasted out the 2011 high, and the XAU. Our opinion on them is the following. Punch up at XAU right now. I think you'll see that. Let's see. This is the only reason I like this one is it goes back to the 1980s. And it's gold and silver miners.
Okay.
Okay. Now that you've seen it, did we go back to what is this?
It goes back to 84.
Oh, 84. Okay. When you do a spread of this, you're not expensive looking like that price chart is. You're at very low levels. XAU divided into the ounce of gold back in the 80s, 90s, and into 2000 was in a range. Oh, there you go. It's beautiful. Thank you. It lived in a range between 17.5% and 30% for those decades up there, where the relative performance of the miners meant that they were of that value of an ounce of gold. They were worth 17.5% to 30% of an ounce of gold. They collapsed to 4% in 2015 bear market, off the page. They've since rallied. You're pushing up again toward what? About 8%. You can see the basing action. Okay, you clear that and you can run to that 17.5% quickly. It's an open field running again. That's a tripling almost in the relative value, a double and a half of the current relative value of the XAU gold silver miners versus gold. Where's the better place to be? Not gold. Gold, silver, miners. Yeah.
And if gold and silver both have a rocket strapped to their, you know what, and they're not staying constant. I mean, that could be a 3x multiple to wherever those metals go to as well.
Yeah, and silver's going to beat gold, we argue, and the silver miners will beat the gold miners as well. In fact, the spread of SIL versus GDX, the silver miner ETF and GDX, has already broken out on a relative spread basis in our assessment. In which case, it's already hinting to us what we think about we plotted it in a different way. But anyway, the point is that if the silver miners are depressed to gold miners, just like silver is to gold, they're both as a category going to outperform gold or gold miners. And as we just saw in XAU, which does contain some silver miners, there's a good chance you could double and a half the relative performance of that category to gold, and probably do even better in the silver components within the mining sector. So if I had to emphasize something, the best to hold in that monetary metal sector over the next 6 months or year and a half even, silver and silver-related miners.
I see. What about platinum? Platinum's down 7% today.
Yeah, it's that's fine. Yeah, we'll look at the chart. Who cares? Okay, it matters on a daily. You shouldn't have been getting long up here. Let me put it that way. So if you're down 7%, that's your problem. The main thing is even on price now. Annual momentum of platinum, which you don't do here. We run it, but you can see that 3 bars ago, that huge green bar, about 3 bars ago, where you came up out of the range, or slightly pushing toward the top of the range. That's when annual momentum broke out and said, I'm back. Okay. What happened to platinum? Went parabolic. Even before it took out that high in 2022 high, which is just below us here. You see the high in 2022? Yeah, that the horizontal line. Yeah, they're right there. See that one? Even before you took that out, back at the bottom end of that bar 4 bars ago, that big green bar, down around go to your right, about 4 bars from the end of where we are now.
Oh, here.
That bar, the bottom of that bar is where annual momentum broke out well before that high was taken out in 2021 high. Okay. Momentum said, I'm gone. And sure enough, in 4 months, look what you did. Now, it was what, a 60% increase, something like that. Not bad. But it didn't wait around. In other words, it said, I'm out of here. What I'm arguing on silver is on a bigger scale. You're gonna produce this kind of action. Where you
so you're saying silver outperforms platinum?
Oh, no question. I mean, platinum has way underperformed monetary metals. I mean, it's moving like the commodity complex.
I see.
And it's not in sync with them at all. I mean, again, while gold doubled from 2015 to 2020, platinum was basically range bound and range bound since, so reflective of the commodity category. But now it's back. Platinum says, I'm back. But I don't confuse that as a monetary metal. It's back because it was cheap too long. No doubt there are some people buying it based on the precious metal attribute, but it is a precious metal, not a monetary metal. It is not money. And ultimately, we're dealing with a monetary situation here, a monetary crisis, a government debt crisis, hence the resurrection of gold and silver.
Understood. Well, Michael, this has been an eye-opening interview, as it always is. Anything else you want to talk about that we didn't get into before we close out the show?
No, I'm watching the stock market because that's what the Fed will be concerned about.
Okay.
They don't care if commodity, they care if corn prices go up because that's, quote, inflation. Inflation's when they destroy the money. Okay. But the stock market, if it breaks down, we're looking at categories that most people aren't. Most people looking at NVIDIA and stuff like that. We think the market already is in a negative long-term momentum trend based on what happened in January of last year prior to the break. That the rally to a new high is a teaser. But to look for downside resumption, don't look at NVIDIA, although it's likely to break too. I'm watching particularly banks. We've stressed this a month ago, and suddenly the last few days it's come up again, but especially Bitcoin.
Okay.
Bitcoin is a pending disaster, possibly a rapid disaster, one that goes down in crash-like mode. And the problem with Bitcoin now relative to the stock market, it is an overlay month by month of the NASDAQ 100 since late 2021. They are virtually the same chart. Meaning, what in the world is going on? Why should a, quote, unbacked money unit behave like the NASDAQ 100? Oh, maybe because it's a speculative bubble.
Yeah, there you go.
Their swing moves are almost month to month the same. When a 6-month decline here, there, upturn. Even in April, we had a sharp collapse in Bitcoin along with the stock market. And what happened? Right back up again. Oh, you got it versus dollar. But if you compared it to NASDAQ, you'd see there's an overlay in the month-to-month Bitcoin price. Month-to-month
NASDAQ. Yeah, NASDAQ's in blue, Bitcoin's in yellow. So they pretty much, like you said, correlate with one another.
Okay. Is that NASDAQ there? Okay.
Yeah, NASDAQ is in blue.
Yeah, okay. Now, the only thing recently that's happened is Bitcoin has dropped fairly sharply. I'm talking Bitcoin futures now. In fact, today they're trading below one of our key first trigger numbers that could begin the avalanche. And this would be an arena which will have an impact on the stock market because so many companies are now heavily embedded in crypto that aren't crypto companies as such, but are now financially committed in one way or another to that market. So that if you kick that market in the gut, it's going to financially hurt them.
Mm-hmm.
Whereas 10 years ago, that wouldn't have been an issue with Bitcoin. Now it's suddenly become intertwined such that it will not just emotionally, but financially have an impact. So you've got to watch Bitcoin, because we're arguing it has the same quarterly momentum trend vulnerability and structure that the S&P 500 had prior to the 1987 crash. And we're toying with numbers now that could generate that.
And if you look at Bitcoin long term, it does appear like it's created this arc pattern. This is on a log scale, by the way, but it does appear like it's created this arc pattern, and you're kind of at this inflection point on the arc coming down.
Yeah, and it's also 3 major waves. The third wave is creepy crawly. And within that wave, there have been like 3 waves as well. But anyway, it's there's a structure pending that could collapse you down, at least 50% rapidly. Well, you can't do that. That will influence not just the people in crypto. And by the way, you could look at other things like Ethereum, which is only 15% of the crypto capital base of the crypto markets. Bitcoin's 57%. So if you want to fantasize and think about the other ones, don't. Bitcoin is the one to watch.
Yeah, Ethereum looks even worse from a long-term charting.
Well, it had a multiple top breakout here recently. You had this horizontal level that prevailed at a certain 4,000, I think it was, and you broke through it and nothing happened.
Yeah,
it was like a launch that fizzled, and you're getting back below there now, which is not a good idea. That means, hey, the breakout wasn't for real; it was a trap. So even Ethereum looks vulnerable, but I'm focused mostly on Bitcoin, with the wave effects it's going to have on the stock market, hence Fed policy. And when they cut rates, it will not be bullish for the market, because that's what they did in 2001, and that's what they did in 2007. And the stock market really started to implode when they started to do that.
Yeah, that's a good point. Is that because it sends a signal to the market that
something's wrong? Yeah, they thought more drugs would be good, but the drugs didn't work this time. They were already drugged up, and they had committed errors over the last 16 years, in those cases, much less time. So we've got 16 years of pricing error based on monetary excess that flowed into that asset category. When that bubble breaks, it will flow somewhere else. And right now, there are very few candidates out there to call somewhere else. Okay.
I guess we'll have to wait and see then.
Don't wait too long.
Yeah. Good point. Michael, thank you so much for coming on, my friend. Where can people find you? They want to see more.
OliverMSA.com. Oliver MSA.
Okay, we will have the links to that down below. And guys, be sure to check out our good partners over at the Bullion Standard Pro. If you want to take advantage of near wholesale level pricing on your gold and silver, then consider becoming a member there. Link is down below, and use coupon code COSM10 at checkout to get 10% off on your first month. And if you got value out of this podcast, drop us a like and comment, "Go, Michael, go," in the comment section. If you agreed or disagreed, let me know either way. I do, in fact, read all the comments. I will try to respond to a small handful of them. I can't get to all of them, but I will try to get to some of them. So drop me your thoughts. I do read them all, and subscribe to the channel so you don't miss an episode. And so by liking, subscribing, and commenting, and doing all the YouTube stuff that I tell you to do, you do support us in a pretty big way. It may not seem like much, but you help in boosting us in the algorithm for this channel and this video. So a little bit goes a long way. It's a nice free way to support us. And if you want to support us monetarily, you can check out the partner for today's video. That's the Bullion Standard Pro. Or you can subscribe to my Substack at CapitalCosm.substack.com to get all my videos early and ad-free and uncensored. So with all that said, I'll catch you later, guys. Bye.